Thank you for watching this video. Today I'm going to sharing about the financial modeling assignments, the initiative coverage. We started the questions about overview. If let's say you are the new junior analyst in the equity research department at the ABC Bank, your boss, the senior analyst, just sent you the following email asking you to build a financial model for company called Blue Containers. So the requirement, the company overview is Blue Container is a manufacturer of a environment-friendly water storage tanks made for recycled materials that are used by a wide range of companies all over the world. The assumption is the most recent statement available for Blue are from 2022. You will therefore like you to build and integrate the annual model for the company for the next 5 years from 2023 to 2027 using the history data and the following assumptions. Assume all figures is in USD dollar. And then the sales in 2022, the net revenue was 594.4 per unit. The gross revenue is 694.4 per unit, less the freight and warehousing costs $100 per unit. This is a cyclical industry and the sales price are expected to average 800 in 2023 and 725 in 2024 and 825 in year 2025 and 800 in 2026 and $750 in year 2027. Then the freight and warehouse costs are expected to increase at in fractions. Blue factory has a capacity of 400,000 units per year. The company expects the sales volume to grow at 5% in 2023 and 4% every year thereafter. And look at the operating costs. A breakdown, the forecast operating cost for 2023 is provided below. The descriptions about variable costs. The raw material is $226. The utilities is $66.20. And the total variable cost is $292.20. What about the fixed cost? The render is $23.50 and operating labors is $43.50 and the others is $2 and the total fixed cost is $69. The operating costs are expected to grow at the infractions thereafter. The SG&A is expected to be $3.9 million in year 2023 and grow at the infractions thereafter. Now we see the capex and the depreciations. The company plans to invest the 16 million on capex in year 2023 and the 17 million in year 2024, 17.3 million in 2025, 17.5 million in year 2026, and 18 million in year 2027. Blue used the straight line method of depreciation. Existing assets has remained the useful life of 25 years while the new assets will be depreciated over the 30 years. Look at the working capital. Based on the history data, please make reasonable assumptions for the working capital days over the next 5 years. The income tax. The income tax rate is 35%. The aggregate reductions on government pre-tax earnings due to the timing difference between accounting and government rules is expected to be 5 million per year for the next 5 years. And look at the debt. The senior secured term debt and Lee Cover pay interest at a fixed rate of 6%. Excess cash earned interest income at a rate of 1%. The amortizations on senior secured term debt will be $25 million per year until the debt is repaired. The company will draw on its revolver if it ever has a cash shortfall. The revolver has a cash sweep such that whenever a revolver balance is outstanding, all excess cash flow after the dividends and shares repurchase is used to pay off the revolver. And equity side, the company has 14.8 million common shares outstanding on the stock, recently closed at $11.50. The dividend for its common shares is expected to be based on the payout ratio of 20% of net income. The other assumption is you now have everything you need to get started, and so we have to build the assumptions. We see at next lesson. Thanks.